Let me share the. Okay, so can you see this binomial model on your on your screen?
Yes, sir. So
Yeah.
can you zoom out a bit?
Okay. Good that you pointed out. So is it okay now?
Yes, sir.
I can do even more, but if I do it more, then I think somewhat, yeah, I'll have to go little left and then, yeah. Is it okay now? Okay. So today we are going to talk about Black-Scholes option pricing model. We did a binomial model, and if you remember, I told you that if you do binomial model properly, and if it is really done properly over a period of time, over various time period, this should ideally convert to Black-Scholes option pricing model. And most people in market, they use Black-Scholes option pricing model for the simple reason this is much easier than the binomial model. And the other advantages of Black-Scholes is like this is mostly based on a statistical formula which is readily available. So for example, a stock's historical life cycle, 4 years, 5 years, or 10 years is easily available, the price of a stock. And so the modeling the price of that stock, whether you want to do it log normal, all the things are easily available and can be used. So that's why this Black-Scholes option pricing model is readily used, and it is inbuilt in the software used by the traders and the fund houses, those who are trading regularly in options. So some background about this formula. What happened in the two gentlemen, Fisher Black and Myron Scholes, in 1973. This period is around the same time when the option started trading in America also. Option started trading in America around the same time when they came out with this formula. So these two gentlemen, Fisher Black and Myron Scholes, came out with the formula to calculate call option and put option on a stock which is not paying dividend. So this is like a rather simplified model where they have assumed that the stock is not paying dividend. Normally, growth stocks don't pay dividend, so you can assume that this model is a perfect model for the stocks like Google, Apple, or like Netflix, Tesla, and all that kind of stocks that are always in demand, or Facebook. So what happened is like in 1973 they came out with this, and then what happened, traders started using this formula, and this became so popular that rather than using their own insight, because normally when you trade in market you use your own insight also. For example, a stock may be at 100, but you may think that no, shortly it is going to be 105, so you buy it, and it may cross 105 also, because that is based on your insight. But if you apply a model can give you some valuation close to 101, 102, something like that. So this formula became so popular that in the year 1997, I think some 23, 24 years thereafter, the duo were to be awarded Nobel Prize, but unfortunately, Fisher Black had passed away by then. And as per the rule of the Nobel Prize Committee, uh, anyone who is not alive, the prize is not to be paid to him. So the Fisher Black didn't get the prize, but fortunately, another gentleman who is known as Martin, who has developed, who has worked also on this model. Further, he has improved on this model. He got prize along with Myron Schultz. So both Myron Schultz and uh, mm, Robert C. Merton, they got Nobel Prize for developing this option price. So just focus on this, how call option is priced in Black-Scholes. So call option value equals, as you can see on the screen, a stock price, which is S, and normal distribution of a factor called D1. And then from this, we subtract the exercise price discounted by risk-free rate. And again, we multiply the normal distribution factor for the D2. So there are two things. Maybe if you have your first time going through Black-Scholes, then this will be alien to you. But if you have seen it in some other application, then you know it how it is D1 and D2. So they have also defined what D1 and D2 is. So D1 is log stock upon exercise plus R plus sigma square upon 2 into time. R is the interest rate and divided by sigma, which is volatility of the stock, into a square root of time. And once you calculate D1, then D2 becomes very easy. How? Then D2 is nothing but D1 minus sigma root 20. Of course, there is formula for D2 also, but rather than going through this circuitous way of calculating again D2, once you have calculated D1, there is no need. So just once you know D1, then D2 is D1 minus sigma root 20. And that's how the call option price is calculated. D1 is calculated, D2 is calculated. Once you calculate D1 and D2, then you need to find the normal distribution value of the D1, which is nothing but a probability, basically, in that normal distribution. After you calculate call option price, either you can use put call parity to price put option, or if you want to use Black-Scholes original option pricing model, then the put option pricing, the formula reverses. Why it reverses? Because you have seen that the price of a put option is nothing but maximum of exercise minus the stock price. But because here we are projecting, and that's why projecting probability factor is important. So we adjust the model like x into e raised to power minus RT, n minus D2 minus a stock into n minus D1. So this is how the put option formula is like used in Black-Scholes. So now we go and see how these things are really applied and how we calculate Black-Scholes option, the option value of a Black-Scholes model or a stock which is listed on any stock exchanges, and the option on that also is listed. So here what we are saying is the 50 is the current stock price. So this stock is available on market at 50. I mean, the cash market gives you at 50. However, the exercise price being quoted for this option is 45. So X becomes 45. Let me write it here. So this becomes easier also. This is stock and this is exercise. This is time. This is small r. This is sigma. It is written also, but that's fine. These are the 5 parameters on which we are going to work. And invariably, these things will be given to you before like you are asked to calculate something. So what happens is, first our duty is to calculate D1. So how we calculate D1, you can also calculate alongside me so that you know how it is done. Because if you don't practice it enough, the problem will be in real situation. If you are really asked, for example, in interview, someone gives you a spreadsheet and asks you to calculate something, then probably you will be clueless. But if you know how to calculate, so you know how to. So the first thing we do is we start with a bracket. Why? Because there is a divisor at the bottom. So I start with a bracket and I write natural log. And then the first thing is stock price. So I select a stock price and then divide this by exercise price and close the bracket. Then plus there is interest rate. So interest rate is this. Plus now here there is slight thing which will help you. The formula D1 is R plus sigma square upon 2T. So if I square sigma and divide by 2, then what will happen? The possibility is that the formula will the Excel will confuse because there is a multiplication with the T. So what I normally do is I write 0.5 into this sigma square, which is this raised to power 2. And then in this one, I multiply T, which is a time factor. And thereafter, like, I will close the entire bracket and then I will divide by square root of SQRT, which is time. So time is again this is this, and I multiply this with uh, sigma, which is this one. Yeah. Now the only thing that I have to think is whether yeah. So I have to use another bracket. If I don't use, then what will happen? The Excel will think that this is going to be multiplied with the whole, and then I enter. So I got 65%. I don't want it 65%. I'll change it to number. So I change it to 0.6509. Similar way, I can calculate D2, but I will just calculate D2 equals D1 minus sigma into SQRT, and that is time. So I get 39%, which is fine. I get 0.3993911. So these two things are D1 and D2 I got. So now to calculate ND1, I will write norm as this, which is I'm calculating the normal distribution function for this D1. I will select D1 and I enter. So I got 74. Why it is in percentage? It should be again in numbers. So let me format it. Okay, so I got ND1. Okay, and then I again will calculate the ND2. So norm is this, and then D2 is given here. I select that, enter. So I got 6521. Now that I have got ND1 and ND2, before I like a question might have come to your mind. I'm sure if it has not come, then probably you are not a good student of finance. That what is this ND1 and ND2? We have used stock price, exercise price, time, exponential, and the volatility. All those things you are aware that volatility is a standard deviation. And why that is standard deviation? Because the stocks fluctuate time after time. Every time you see something and something is happening in the stock. But what is this ND1? So we'll soon see because we are going to also talk about option Greeks after this black shells are over. That ND1 is nothing but call delta. ND1 is nothing but call delta, which is what we'll be using. But then there are modification of this, which we'll use when you use Merton model. So as of now, you just understand ND1 is nothing but call delta. So why black shells have used this ND1? Because they want to be sure that if a stock there is a movement in the stock price from where it is now, how will the call price move? That's why they have used this factor called ND1. And again, then you might ask, what is ND2? So ND2 is the second part of this black shells option pricing model. As you can see, the call option pricing is minus X e raised to power minus RT into ND2. So X is the exercise price, and you are discounting it because you will not be today you are pricing this option. You are not pricing option in the future, because in future there is no need to price because everything will be clearer, and the differences between the stock and exercise can always be implemented. But we are discounting it because we are doing it the present value. ND2, what it does, it assigns a probability that what is the probability that this exercise price will be materialized. Because for example, the exercise price here is 45. Okay, let's say at the time of expiry, the stock price is only 40. Then there's no point in exercising the call option, because in the market that cheaper and you are going to pay higher price. Okay, so these two terms, ND1 and ND2, you should always remember. If someone asks you what is ND1 and what is ND2, then you should be in a position to clarify what ND1 and ND2 mean. Now coming to this call option pricing, so we'll use the direct formula, which is S So S is this 50 into ND1, which is this one, minus exercise price, which is this one, into ND2 into exponential, because there are, and minus RT. So minus, there is rate 4%, and what is the time period is 3/4 of a year. And then I think we are done. So I hit enter. This is okay. So I got 8.643 rupees, because I assume that everything is in rupees. So everything, since everything is in rupees, so the call prices also is in rupees. Now I can calculate the put option pricing by two ways. And two ways, one is put call parity, the other is by directly by using the Black-Scholes model. So if I use put call parity, what is the put call parity thing is C minus S, the C call option, and plus the discounted value of the exercise. So this discounted value of exercise is X into minus R into time. And I'm done, I think. So okay, so I got this 2.31, which is like I used the put call parity. But what if I use the Black-Scholes original pricing model? So let me use that also. Just for your sake, formula is also there, but you can see the formula here, X E or minus RT and minus D2 minus S minus. So we'll use that. So I write X is nothing but the exercise price into exponential, okay, and minus RT, so minus 4% into time. I close this bracket. So one side of the thing is, and then I have the normal, because in Black-Scholes the norm is this is also to be used, and I have to use minus D2 here, because this is calculated in the other way. So I'll just I write this function D2, and I take it minus the first part is done. And from here I subtract again the stock price, which is the formula, and then I multiply this with norm S is minus D1. So minus, and then this D1. Then I press enter. So I got the same price exactly. Only thing is, it is showing, because there has always some, because I do macro, and because of macro enablement, some problem comes in the PC. So nothing to worry on that count. Fine. So exactly I got the call option price, put option price, either by put call parity or by directly using the Black-Scholes model. So I have got call option, put option, and put option directly by either as using the Black-Scholes model or using the put call parity. Now the most important part of our discussion or this session is, do you really need to go through this circuitous way, or like a long way of entering the stock price, entering the normal distribution value for D1, and then subtracting from them the exercise price, multiplying that by the or discounting that by the interest rate, exponentials of interest rate and time, and then multiplying that by the normal distribution of factor D2. So the answer is no, because this was just to drive home the point that this is how actually like 20 years or 30 years back in classroom, someone would have been very happy to learn this way. And also there was no other way to do this. But since, as you know, since 1995, the Windows came, and then Windows changed everything, and people started using the Excel. So once you use Excel, then obviously you don't need to go through this CPP either by direct Black-Scholes formula or by put call parity. So very easy in our like VBA model. I have already model is I write BS call. Okay, and then the only thing important here is I have to assign it in the similar. Just remember this, because chances are that in your examination, if like you are given all this value of stock size, time, interest rate, and volatility, and you are also allowed to use the VBA function, because this you can take it. So the important thing is the order should not be missed. If by any chance you miss your order of calculation, then what will happen? Answer will be very different from what is actually expected. And then I press enter. So I got exactly the same price, exactly the same call option price as I got in case of direct calculation. Similar way, I can use PS put, and then again I have to go through the same stock price first, then exercise price, then time, then interest rate, and lastly volatility. And once I press hit, then I got the put option value for the same stock directly.
Oh,
Yeah.
can you just hold on for a minute and can you show the formulas once again that you have used? Like it will take for only 2 minutes because I am not able to get the same answers. That's why I'm asking.
Which formula you are talking about?
D1, D2, ND1, BS call and BS put.
Okay. Okay. So yeah. So okay, just a minute. So can you see this? Like, okay. So are you able to see this?
Yes, sir.
Yeah. So this is exactly
Yes,
what
sir. Yes, sir.
I've not used anything different. I've not used anything different. Okay. Let me. So if you want me to calculate D1 again, okay. So just see how I calculate D1. So D1 is nothing. I've deleted what I did. D1 is nothing. So I start with natural log, and I enter the stock price, which is the 50. I divide this by X because this is in formula. This is, I'm not doing anything extra because this is this. So I forgot to tell you one thing, that if you don't memorize the Black-Scholes option formula by heart, and there should not be a delay of even second, because if there isn't like you're taking time to recall this, so you're completely missed out on this, because this is one of the most widely used formula in financial market. And also, like, people love to ask you about Black-Scholes formula, because this is something that people understand that this was probably the most difficult thing at that point of time to do, and that's why this is something to. So there is no way out. You first memorize the formula and then start practicing it. Anyway, so I entered the interest rate, and as I told you, I will use 0.5 volatility square. Why? Because then it's so 0.5 into this volatility raised to power 2. So this volatility square I have done. Then I multiply this with time, which is 0.75. Then I divide the entire thing. I take a bracket, because if I don't take a bracket, the Excel will not understand that the whole thing is being divided. So first is sigma and into SQRT time. That's it. and then one more bracket is required because and then I press it. Here's missing here. Yeah. So this is how we calculate D1. So if I calculate D1, similar with D2. D2, as you can see, the D2 is D1 minus sigma. D2 is D1 minus sigma root under T. So once you calculate D1, then nothing much you have to do. You have to just subtract D1 minus sigma root under T, and you are fine with that. Once you calculate D1 and D2, so for this ND1, you have to write norm S this formula, norm S this, and just select the D1 factor, and you will get and you press hit, and you get 6371. Okay. And for D2, if you want to calculate ND2, so again you write norm S this, and you select 2, and then you get 0.5362, and then accordingly this the value of
Sir,
yeah
yeah, thank you, sir. Just show the BS call and BS put also now.
yeah
See,
yeah
yeah.
yeah. So base call and base field is the easiest. It's like a child game. So I just write here BS call. Okay. So now Excel understand because it's already programmed in this way. And what you have to do, the only thing that you have to remember is first value should be a stock price, second value should be exercise price, third should be time, fourth should be the interest rate, and the last one should be volatility. You close the bracket and then press enter. You get the price of 8.64. So this is how you get BS call. In case of BS put, again, like I'll delete this and write BS put, and again in the same order, like stock price first, exercise price second, time to maturity third, risk-free rate fourth, and volatility fifth. And then I close the bracket and then hit enter, and I got the BS put. So exactly the same. Here there is slight problem. As you can see, there is slight mismatch between this value because the D1, D2 Excel calculated slightly differently. But nothing to worry because, as I told you in the beginning, sometime back also, because of some issues, but I'm sure you would have got this value 8.64 to 0.39, and D1, D2 you would have been perfect in your case if your Excel is free from any virus. Seems to be some issue with it. So nothing to worry. Always remember that if your formula is right, you should not worry what value you get, because if you input the proper value, you'll get the answer. So this is how we get BS call and BS put. So you don't need to do this call option, put option either directly or indirectly through put call parity. So this is what will be expected of you, that you can use BS call and BS put in the examination or like here, because this is just like a part of our daily culture. So no need to go through this the formula for C equals S and D1 minus X into E raised to power minus RT into MD2. So with that, now we come to an exercise, which is this is the exercise where I have changed the stock price to 100. I have changed the exercise price to 100, time to 1 year, interest to 10%, and volatility to 40%. Now, with based on this, you have to calculate call price and put price using BS call and BS put. I don't want you to use the long route of calculating C and P through the traditional method, because this is not the job of the financial modeling person. Because you have the formula, so use direct formula. So use the call price and put price for these two, and thereafter, like you repeat this for call and put for this entire thing, and then we talk about this. So just all of you first do this. Anyone, I'm sure some of you will have the problem. Then you discuss here only, and I try to rectify this, and then you will move on to the next part.
Sir, can you show the BS call option formula, please?
So this BS call, as you say, so this you have to use the stock price, exercise price, the time to maturity, interest rate, and volatility in that order.
Yes, sir. Can you just move it upwards because I'm having a bit of problem with my computer. That is why. See.
Okay.
Okay.
So yeah, is it okay now?
Yes, sir. Can you please show for BS put formula?
You have calculated.
Yes, sir.
BS,
For BS
yeah. So
call.
BS put also you have to write BS put and then take the same order: S stock price, exercise price, time, interest rate, and sigma, and then I can write here so that it becomes easy also. So let me write here. Ah, yes. Stock, the size, time, R, R, and sigma, and that's it. So this is how you do for BS put. I write for BS call also, so you remember. So
Sir, I've got the formulas. Sorry, I got the answer for BS call and BS put, but call option are a bit whimsical answers.
why?
So they're coming like 0.18, 0.4, then increasing at 14 and 20. So I'm not
Uh,
exactly sure.
can you share your screen if I can see, and then I can tell you, because without seeing it won't be easy. So if you can share your screen, probably I can throw some light. Could you solve this, all the prices for calls and puts?
Yes, sir.
Is it done? Okay, so what is the call price for 40 stock price?
So it is 0.1802.
Okay, and for 60?
Sorry, 60, it is 2.3019.
Great, great. And put price for 60?
32.7857.
Great, excellent. So I'm wondering why others were taking time. So if you have done this, just do one more last thing before we move to the next thing. So plot this call and put on a XY, whatever you have got for from 40 to 100, plot call and put prices on a XY scale, and then see the relationship. I want you to see some certain relationship, and that will clarify some of the knowledges required for understanding Black-Scholes. So just select call and put, and then go to chart and insert a chart and see how the call and put are behaving. And if it is like coming well, then fine. Otherwise, I will tell you how it should be. Let me also, in the meanwhile, insert these values. So then I can. Okay, so just let me know when a chart is done.
Done, sir.
Okay, so what do you see in the chart? When you have done the chart, what is the relationship that you see in the put and call prices? So
So
one,
initially call was lesser than put. However, as the stock prices increases, call was greater than put.
just come up once again.
So like initially when the stock prices were lower, call price was lesser than the put. However, as the stock prices increases, so does the call prices against the put. Like
So
call,
slightly, I know that what you are saying is correct, 100% correct, but you are probably mixing it, and then so like let me rephrase what you are saying, and then you just tally my statement with yours. So call option price is increasing function of the stock price. The graph should be showing the upward moving call prices. Whereas for put option price, the price for a put option should be decreasing function of the stock price. So like if you can see the put of prices chart falling down, sloping downward, whereas call price is sloping upward, and if the two are intersecting somewhere close to 9, between 85 to 90, so I think then it's right. And it should be right, because as you can see in this, like if are you able to see my Excel?
Sir, sorry, sir, we lost you in for between. So can you please tell what type of relationship? I could only hear degrading relationship.
No. So can you see the spreadsheet that I am using?
Yes, sir, I can see that.
Yeah. So as you can see, as stock prices are moving, the call prices are also increasing. So what I'm saying is, as the stocks move up, the call price should go up. Whereas when stock prices are moving, put prices is going down. So this is what is the relationship I wanted you to see through chart. That if you plot this on XY scale, you'll realize that call prices will be upward sloping, whereas put prices will be downward sloping. And this is exactly the thing that you should remember and memorize, because this will be required when we calculate volatility, when someone asks you some certain things about the interest rate and volatility and all that. Whether, again, the same question will come, that what is the relationship with volatility and call and volatility and put. So again, like depending on your understanding of the topic, you will be in a position to, but this is very straightforward. As you can see, call prices keep on increasing as you increase. So for example, if I make it 120, okay, and then I drag this down, so this call price becomes 35. So whereas call price was just 0.8 for 40, 120 it has become, and put price even falls further down. Put price falls further to 5 rupees if the stock price goes to 120. So basically, relationship is inverse with put price and direct with call price. So the higher the stock price, higher will be call price. Higher the stock price, lower will be put price. And this is what I wanted you to see through charts, because there are n number of ways in which you can create chart. You can create all at one, you can create separately, but the relationship will always remain the same. So okay, let's move to the next important thing. So what we have learned in Black-Scholes option pricing as of now is the call option prices can be determined from on the basis of stock price, exercise price, interest rate, time, and volatility. These are the 5 things that are required, and then call option prices can be determined. The $1 million question in market invariably there is a situation that the call prices being quoted by someone or the put prices being quoted by the traders in market is different from what you have calculated, or probably you will calculate using your Black-Scholes option pricing model. The question that you should be asking is, why is so? Because if Black-Scholes prices are so powerful, and if they are so important, and if so widely used globally by everybody, why is it that the market price of call option and put option is different than the one calculated by your spreadsheet or your any analytics that you are using, any software that you are using? The answer lies in implied volatility. What happens is, the volatility that we have been using till now is the historical volatility. So for example, 5 years, if you take the ICICI price or Nifty price of 5 years, and if you take a standard deviation of that, it becomes the volatility for that particular underlying. Whereas it's not necessary, as you have seen in like when we were doing this Black-Litterman approach, that it's not necessary that you 100% agree with market. So chances that your understanding of the volatility will be different from what others are understanding. So what it means is, what you are employing in your call option pricing is that your volatility is different from others' volatility, and that's why you are asking for higher call or put prices. So there is an indirect way of calculating the implied volatility from market prices, because anyway other prices are very visible. Only thing that is not visible is the volatility, because if you open the exchange's website or any broker's website, the stock price is visible to you, exercise price is visible to you, interest rate is risk-free rate, so the central bank rate is not changing daily, day by day, and the time frame is always known to you. No one decides the time frame, but it is always decided. For example, options in India are traded for 1 month, 2 months, 3 months, whereas in case of S&P 500, the American option, they are traded for 1 quarter, 3 months, 6 months, and 9 months, and then like the higher than. So those all four things are known. What is not known is the volatility. So this is why it is important to calculate implied volatility using Black-Scholes option pricing model, and then get to know whether what you have calculated is the right what you are implying from Black-Scholes is the same as what the market is doing. So here is the one example. So on the date on which we are doing this calculation is 9th of October 2012, and the option will expire on 19th January 2013. So we are 3 months ahead of, we are deciding. Why? As I told you that American options, the minimum tenure that is available is 3 months. So you don't get to see 1 month as we see in India, but in America it's a 3 months. So this is the date on which we are calculating, and this is the expiry. The difference between these two dates will be the actual time period. But because this will only be if you subtract this from this. For example, if I subtract this minus this, I get 102 days. So 102 days, because all in our option, the time period is in year. So I divide this by 365. And this becomes 0.279452, which is what this is, which is what you can see that I have already entered this. So current price of the stock is visible from the screen. So you have we have taken this 144.2. Then the strike price is like for different options, there are different strike price. So we are calculating implied volatility for a strike price 144 given. Time to maturity is what we have to calculate. Why? Because these things will not be visible to you readily. The only thing visible is current date and expiry date. So on the day expiration date, the 19th January, the differences come to 102 days, which is 0.28, close to 0.28 ES. And then the interest rate is 0.08%, because normally in America, the rates are very close to zero or hardly 0.25 or 0.2 or 0.15, something like this. But if you take that quarterly or divide by 4, you are not going to get the large interest rate. So the interest rate calculated taken again is from their market. Now, actual call price market is showing you 4.74. Actual put price market is showing you as 4.91. So this is also because if you are trading in options and futures, you will realize that these prices are also visible on the screen, because buyers and sellers are quoting their call prices and put prices. Call prices and put price. If you want to buy call, buy. If you want to sell call, sell. But the quotes are always given on the screen. So we have taken this, the best call price and best put price we have taken from this screen. Now, if this is actually the price, if this is the call price and this is the put price, then what is the volatility? Because we have calculated call and put price given 5 factors. Those 5 factors are what? Stock price, exercise price, time to maturity, interest rates, and volatility. Here we are doing the slightly tweaking it in the way that we are given the call price and put price and all the 4 factors for Black-Scholes option pricing model, but we are not given the volatility. So I have made life very easy for you. If this wasn't the formula, then again it would take a lot of hell out of effort from your side to first calculate call price using certain number of value for the volatility and keep changing in and then come to a certain conclusion, or maybe use solver to get to that. But here what happens is like we have the programmed function for the implied call volatility, which is what we call call volatility. All you have to do here again is the order you have to maintain. So order is, the first one is the current stock price. The second one is the strike price. The third one is the time to maturity. The fourth one is interest rate. And the fifth one is the actual call price, where this is different. In the BS call, we are using the volatility. Here we are using the call option price, and I hit enter, and I got the price 0.15219. And incidentally, this has given me the value in fraction, which I can make it as percentage because volatility looks better in percentage. So this is 15.22%. Okay. Now, you know that the volatility is 15.22%, but whether this is right or wrong, we don't know. The VVA that the Excel has calculated it right or wrong way. So we want to cross check this by using this as an input in Black-Scholes and calculate what would be the call price if this is the volatility. So we'll use BS call, and then again we use everything in the same order: stock price, exercise price, time, interest, and then this implied volatility, and see whether our big price. So we got exactly the same call price through Black-Scholes option price model. So the implied volatility that we calculated is the right
Sir,
volatility because
yeah.
I'm sorry.
Can you show the formula once again?
Yeah, call volatility. I will write that. So just hold on. So this, if I have to calculate this implied put volatility. So again here I will write put volatility, which is the formula, and then I have to first use stock, then exercise, then time, then interest rate, and then the last one is the put prices, and then I hit enter, and then I get this. Here I'm going to write the formula so that you don't have to look every time on the cursor. So we write put volatility. Then what we write is first stock value, then exercise value, the time, then R, and then the price of put option. Here's the price of put option, and this is. And in case of call, we write call. The formula is call volatility, and then again stock, exercise, time, interest rate, and then the price of call option, which is what we call it C. This is C. And this is P. So if I again use the Black-Scholes put for this, so I use BS put, and then I use the same input of the stock price, exercise price, time to expiry, interest rate, and this volatility. I want to check whether this volatility is fitting into my Black-Scholes option pricing. And what I see is this price is matching with this price, which is the textbook answer for Black-Scholes price, and which is also the same thing as here, like actual put price. So the put volatility that we have calculated is conforming to our Black-Scholes option pricing model. So this is how it is to be done. Formula I have written. So like anytime you're in doubt, just use this formula: stock exercise, time, interest rate, and call. Stock exercise, time, interest rate, and put, and you get implied call. But this is most important. Whatever we have discussed, of course, everything is very important. About Black-Scholes is like a biblical phenomena in terms of stock market usage of the same. But this implied volatility calculation is $1 million formula. Why? Because invariably you'll find that your estimation of a call and put price, whether you use binomial or you use Black-Scholes, will be different from what market participants are quoting. So then you need to come back and calculate implied volatility for call and put, and then you gauge that do you really think that market will be so volatile? Do you really think that the war is going to last longer? Do you really think that oil prices are like going to further rise from here? Yeah. And then you calculate your implied volatility on the basis of that, and then conform to this. So this invariably you should be doing to get to the right volatility in the market, because then this will give you the direction that market is anticipating higher or lower than what you are doing, and then you can take a call whether you want to be into the option or you want to be out of the option. Now we go and do a certain different thing, which is the black model for valuation of an option on bond. So what happens in the year 1976? Fisher Black also came up with call option value for pricing a bond. Why pricing of pricing option on call option on bond is valuable is because bonds are also largely traded in Western markets. Of course, in India, it is not very heavily traded, but things are happening.
Yeah.
I'm sorry. Yeah, you said something? Someone said something? You want me to repeat something? Himanshi, Rashi?
No, sir. Actually, just the mic was on. Sorry, sir.
Okay. Yeah. So, yeah. So, what happens is, just I want you to focus on this, where my cursor is, that C equals E raised to power minus RT, F N D1 minus X N D2. If you can see and compare this with the call option pricing formula for Black-Scholes, you will find that this formula is slightly different than the one used till now in case of Black-Scholes. What is the difference? The difference is the factor e raised to power minus t is also being applied with the first part of the option formula, whereas that was not the case in case of the stock the call option pricing in case of a stock option. So this is just one thing you have to remember. Why? Because this is the how he developed this formula. Of course, this can be derived. It's not very difficult, but in our it is not our duty to look into how a formula is derived. We have to take a formula as it is because we are just modeling it in our Excel. So this is the call option pricing, and if for a bond, if this is the pricing, then D1 becomes slightly different than what we use. So in previous formula, we were using R plus sigma square T upon 2, whereas here we are using just sigma square upon 2. And D2 is the same as previous D1. So D2 equals D1 minus sigma root under T. And then the price of a put option here again is slightly different from the previous one, because the previous one there was no e raised to power minus in case of the second factor, whereas it is also multiplied with the second factor. First factor anyway it was there, but the put option price is e raised to power minus RT x n minus D2 minus e raised to power minus RT f n minus D1. So this is slightly different than the call option pricing on their stock. So now what we are going to do is we are going to calculate using black model the price of a bond call option on a bond. So for example, the on NSE, okay. So one more thing I wanted you to understand, that the same model is used by NSE to price option on bonds. So all the bond futures listed on National Stock Exchange of India, they are also using the same model, the Black 1976 model. You can do a Google search and you'll get lots of literature on this, that what they are using and why they're using. So anyway, so like we take forward price from market as 133, exercise price at 130, interest rate given is 4%, which is very similar to our interest rate of 4%, the risk-free rate for maybe 6 months or 1 year. Time period is 0.5, means in half an year this option is going to be exercised, and volatility is 6%. So this bond price is volatile, this 6% in a year. Now the first thing that we need to calculate is D1. So we'll calculate D1. Okay. So what is the formula for D1? Is the same as the previous one. Slight difference, as I told you, is there is no R. So I take a bracket because there will be, okay, and then I take the forward price first, which is this one, and divide this by the exercise price, and I close this bracket. My bracket is closed. Plus I take 0.5 sigma square, because the formula is sigma square T upon 2. So I write 0.5. I multiply time, which is 0.5. Then I multiply the volatility square. Then I close this bracket. and I divide this by sigma, which is this one, into the square root of time. Which is 0.5. I close this and then I'm fine. I can hit enter. And then I got 56%, which is similar to what is there in this case. But let me change this to number. So I got one. And once I get D1, then for D2, I don't have to do anything. Just from here, I subtract sigma into root under t. So sigma is given as 6% into square root of time, which is 0.5. Then I get 52%, which is nothing but the same thing because 0.5 it fails. So I got both the D1 and D2. Okay. Now, how is the call price calculated in case of the what Fisher Black has used? So the call
So
price
can you
has,
please show D1, D2 again? Like I'm missing something in my formula.
okay, just see this. Just see this.
So can you please press F2 so that it highlights the cells?
Uh, I think it's my cursor is already there. You can't see this.
Okay, so now I can see.
Yeah.
Just please wait for a minute, sir.
Yeah, no problem. Hello. 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 हेलो या हाँ बोलिए मैं क्लास में हूँ ऐसे आप बताइए कोई बात नहीं थोड़ी देर बात हो सकती है अच्छा ओके हाँ अच्छा गुड हाँ हाँ अच्छा दे दीजिए फिर 9+2 मेरे ख्याल से 10% तो बढ़ ही गया पिछली बार जो लड़की दे रही थी उससे ज़्यादा देखिए अगर वो 10+2 होता है तो ठीक है नहीं तो वो 9+2 में भी प्रॉब्लम नहीं है देख लीजिए हाँ करेक्ट हाँ हाँ हम्म, अच्छा बट वो बस उसकी स्टेबिलिटी कैसी होगी मतलब वो फिक्स हो जाए हम्म, चलेगा फाइव तो ठीक है वो एक हाँ मैंने फाइव करके पढ़ा पार्टी और वो जो दो टर्म टर्म यूज मैं आपको कॉल करता हूँ थोड़ी देर बाद। हाँ चलेगा। Yeah, Mihir, you're done.
Yes, sir. Not done.
Yeah. So then, like, if you have the forward price, exercise price, risk-free rate, time, and sigma given, because this will be known to you if you are trading in a bond. So the next challenge for you is to calculate the call price and put price. So based on this formula, like we'll use this formula only, and then we'll write, because so we'll use exponential, and in the formula the value is minus RT. As you can see, the value is minus RT. So the interest rate is 4%, and then time is 5%, and then we close this bracket, and then from here we multiply this again. So we'll have to start a bracket because this is going to multiply the forward price into norm S risk, and we are going to use the D1 value, because first we have to use the D1 value. So then D1 minus, then the next thing is exercise price. So again we write exercise. So this formula is similar to the previous Black-Scholes, but slightly different, because we are we are discounting all the forward prices. So we wrote exercise price, and then from here we have to multiply the S is okay, and we'll use this time D2, which is what we are using, and then we have to double close it. Why? Because there is another bracket, and then so call price I got is slightly different, but then probably it could be because of the problem in Excel, not because of the formula. So you just check and let me know what is your call price, and then for put price again I will use the same formula, which is exponential minus RT. So minus 4% into time is half year, and then I close this bracket and I start another bracket, and then write exercise price. So exercise price is 130. Okay, and then from here there is slight difference in when you calculate put price. Why? Because the distribution is negative. So we write norm S this minus D2 first. So minus, and then this D2, and then the first part is done, and from this we subtract the forward price, which is the first function, into norm S this and minus D1. So minus D1, and then you have double close because we have used one more bracket in the beginning, and we hit, and then I accept this. This is exactly coming as right, but the first one there was some okay. So this is exactly the textbook answer. So we got the price of a call option and put option on a bond, which is going to be maturing in 6 months from now. The actual bond could be lasting for another 2-3 years in time. So this is how you calculate the price of a bond. This is very important if bonds are heavily traded, even if not heavily traded, but many pension funds and many the investment bankers are keen to get into bond, because they can sense the interest rate movement, and if you can sense the interest rate movement, you make more money in bond than you make in stocks, because a stock can still be less volatile, but if interest rates are changing, the market can change along. Now, the one question that you can ask is, how do you get this forward price? Because exercise price is known in case of all bond, interest rates are known, time of expiry is known, volatility is the historical prices where you calculate the standard. But where do you get these forward prices? So forward price is nothing but the simple time value of money we calculate. But that can also be calculated using this a spreadsheet. So let's see like how we calculate in case like you are not comfortable with this, that how do you get? So how do you calculate the forward price of a bond? So here we see that the bond will actually get mature in 2 years. Bond will not last more than 2 years, but the option will expire only in half year, like 6 months. So after 6 months, anyone who buys the bond will continue to retain the bond for another 1.5 years, and that's why this is being priced. The maturity value of the bond is given as 147. So if you buy a bond today at whatever price, you will get 147 for sure. The interest rate to end means like if you retain the bond for 2 years, so 2-year interest rate in market is quoting as 6%, and 6 months interest rate, because you are pricing the bond on 6 months option, so 6 months interest rate is 4%. Now the question is, what is the forward price? So this you have to memorize, because there is no there's no quick formula for this. So forward price of a bond here is, first you have to write the bond maturity value. So maturity value, I have given this in formula. If you go here in the formula section, you will see this, but nevertheless. So we write the bond maturity value, and from here we discount it using exponential factor. And what is the longer term interest rate? So longer term interest rate is 6%, which is 0.06, and here we multiply with the longer term interest rate, we multiply the longer term tenor, which is how much time? 2 years. Then we close the bracket. Okay, and from here we multiply another factor, which is again exponential, and we write shorter term interest rate, which is short interest rate is this one. Okay, then and here you multiply the short interest tenor, which is 6 months, which is T. Okay, and we close this bracket, and then we are done. And if I press enter, do I need to use double bracket? No, not required. So I got the same price. I got the same price as was the price here in case of the black model. So in case a bond is trading in market with these features, you can calculate your own forward price, and then on that forward price you can calculate the call price and put price, and lots of money you can make, because it's illiquid. The other is, not many people have knowledge of the bond market. Knowledge of bond market is very limited in financial market. Most people think that they can price stocks because they can see the business, but for most people it's very difficult to price bonds. Why? Because they are not they have no clue about interest rate, duration, and convexity. So this is where this comes handy. So just put your cursor here in the spreadsheet, or maybe I will send it to you, like in case like you're finding it difficult. So this I will send right after the class, and then you can practice. But practice it's so many times that for you it's not an issue. So then it becomes a part of you, and definitely these two things are very important. So you need to memorize and retain them. Now we go and talk about option Greeks. So there are 5 option Greeks. So one is delta of both call and put. Then the another one is gamma. So gamma is nothing but the second derivatives of delta. So gamma is nothing but delta square call upon delta stock S square. So if you are familiar with differential or integral calculus, you will know that this is not anything that great. Vega is nothing but volatility, but volatility of change in the call with respect to the volatility. So delta call upon delta sigma. Then the next Greek is theta. So how much with the passage of time, how much is their change in the call price? So delta theta of a call and theta of put, they are negative function of delta call upon delta t. And then the last Greek is rho, which is related to interest rate. So how is the call price sensitive to interest rate movement? So again, this is also calculated using delta of a call upon delta of the interest rate, d upon dr of the call with respect to the change in price of call with respect to interest rate. So you do the first differential of call price with interest rate and you get these functions. Now, the $1,000,000 question in this is like, how do you do this? Because if you take the first derivatives, it's going to be very time consuming, and the other thing is terms are going to be extended to a maximum possible number of terms. Why? Because if you remember, if you take the derivatives of any number, the factor that gets multiplied gets carried away, and if within the factor, if there is any variable of that derivatives, so that also has to be derived. So like by a simple rule, it's more likely to get extended. So there is some there you could face some issue, but nevertheless, just focus your attention here and we'll see how it is done. Now, if you can say this formula, call price is a stock price into e raised to power minus kt into n d1 minus x into e raised to power minus rt into n d2. So this call price is slightly different from the one that we have used in Black-Scholes option pricing model. So what is this formula? So this is Martin on dividend paying a stock. Okay, so this formula was derived by Merton, and now so this is very easy to memorize if you memorize Black-Scholes option pricing model. So what you see is C equals S into N D1 minus X into e raised to power minus RT and D2. The only thing different here is e raised to power minus KT. Just remember that K is nothing but dividend distribution, the dividend that is distributed by a company. So if the dividend distributed is 2%, so we take K as 0.02, and because this is negative, so it is discounting the price of a stock on the basis of the dividend that is indirectly being incorporated in the stock price. So if you trade in market, or if you have the understanding of the stock market, you will realize that the stock prices invariably incorporate dividend. So the actual price of a stock, if you deflect by dividend, then that's actual prices, and this is what this formula is doing. So we are using Merton option pricing formula to calculate option grid. So if you use Merton model, so then both call option and put option prices change slightly, as you can see. So just remember this, nothing much to change, but only thing that's changing is e raised to power minus kt. But because something is changing in call option, so D1 also is changing, and here what you see is minus k, which is different in D1 than like what was there in the Black-Scholes option pricing model. And this is the reason why I'm going to use a different sheet for this Merton and the option grid. The reason is D1 we have defined in previous Excel sheet as log S upon X plus R plus sigma square upon 2T, whereas we are going to use D1 as R minus K plus sigma square upon 2T. So because it's going to change, so the two formula will conflict with each other. They will not be in agreement. And that's why, like on this sheet, it will be very difficult to program it. So we'll take this to the second file that I've shared with you, which is a grid. So let me come out and then stop presenting. And then again, so like let me okay. So I don't know whether this is visible to you. Can you see my screen? Main, can you see my screen where Greeks are visible?
It's loading, sir. Now it's visible.
Okay, okay, good. So now that it's visible, so we go and talk about option Greeks. So as you know, there are 5 option Greeks, and we are going to calculate those option Greeks only. So calculating them by using the formula is going to be difficult. So we are using the same formula, this current stock price of 100, exercise price of 90, time to expiry of half year, interest rate of 6%, dividend yield we are using the K that is used in this formula, we are using 2%, and volatility we are using 35%. Now, if you have to calculate D1 and D2, should not be a problem. But again, I will, for the sake of class, I will calculate it so that I think it's calculated. Yeah, it's calculated, but also like no problem. I will calculate it once again. So very quickly, I will calculate the stock upon X. So a stock upon X, calculate bracket plus R minus K plus 0.5 . Oh, sorry. Yeah, 0.5 into 0.5 into sigma square, which is this raised to power 2. Okay, I missed something, but I'll rectify that, into time, which is 0.5. And I need to use a bracket here, because without this bracket it will not know. And divide the whole thing by sigma, which is the stock volatility, to QRT time 0.5, and double bracket, and I hit enter. So, oh, this is different from so D1. No. Should not be a problem, but formula looks good. But why is, let me calculate D2 first and then see where it is. So it looks like this is there is something wrong here. Let me see once. So log of B2 upon B3 is fine, plus B5 minus B6 plus 0.5 into B7 square, which is again the part of formula. I can close the bracket and multiply with B4, which is time. That is also fine. I divide that by B7 into a square root of B4, and but why is this? That's very surprising. Sometimes there is no reason why it should be like this, but anyway. So I recommend that you guys check this with your ideally this should be exactly similar to this, because there is no but anyway. So I will share with you, try and see, because looks like that Excel is there is some error in the find. Now when it comes to calculating ND1, so we calculate norm S list, and then we use this D1, and then we press enter. So we got exactly what is required, and then here we calculate norm is this, and we use this D2, and we get B2 value. Now call prices can be calculated again directly, like using the BS call, but here we are going to use a different formula, that is the Martin formula. So what we are going to use is this here. I'm not going to use calculate the first call price, which can be used by this formula. So I will use which VVF model formula, which is BS Martin call. And once you have this, then you have to follow the same sequence, which is called exercise, time, risk-free rate, dividend yield, and a stock volatility, and you are done. And then you have to press enter. So you got 16.15, which is exactly same to textbook answer. Okay, so that's fine. Now again, coming to put prices. So again, we'll use for put the BS Martin. Okay, and again the same number of sequence we'll use. 1, 2 exercise price, third is time to expiry, fourth is risk-free rate, fifth is dividend yield, and sixth is the stock volatility. And I close the bracket and I hit enter, and I got 4.49, which is the same as this put price. So I have got this Black-Scholes using the put and call prices or the basis of Martin formula. Ideally, I should also be doing this call Greeks using this circuitous way of using the formula, but because we are about to finish, so I just want to use the the direct straight formula for calculating delta, and which you should be remembering. So the first thing that we use is delta call, which is the second one here that you can see. And then in delta call, I use everything which is there in case of. So I use first this risk-free rate, dividend yield, and a stock volatility. I close and I get the call delta as 0.78. Then for gamma, I use formula. Yeah, you're saying something?
I have a suggestion.
Yeah.
So can we please stop for today, because it has been too heavy session, sir, and
Okay.
geeks are important, so that is why I was hoping.
Yeah. Okay,
that we could stop.
very good suggestion. In fact, I wanted to calculate something else also, so that like you could see it and understand it. So that so you're rightly saying, even if I would have done this call, what would be remaining, and this brute force calculation also, I wanted to show you that how difficult it is when a student is given a textbook and pen and paper to solve this. So I will stop here only. No issue. I will stop here, and but I will recommend one thing, Mihir and to others also. If you guys are interested in learning Black-Scholes and the applied volatility and the option pricing on bonds and other things, there is no way you have to memorize the formula. I also memorize. I remember each and every part of this formula. Anytime I am stuck up somewhere, then all I do is just write the formula and then check that what I'm writing is the right or wrong. So irrespective of whether you are failing in the writing the correct formula, but the original formula you should memorize and then start somewhere. Excel will show you the way. So okay, then I will stop here, and the next session I will start with the same Greeks, and then we go and do the bond valuation, because the next chapter is on bond price and other things. So that will also aid you in this. So any question if you have, then you can ask me, or like then we call it a day.
So one question relating to Excel.
Yeah.
Sir, you have written macros everywhere, like in this delta, gamma, and in the Black-Scholes put and call. Sir,
Yeah.
can you please teach us a way that we can consolidate the macros written in various files into one single file?
Yes. So just do one thing. It's not very difficult. So let's keep it doing. And finally, what will happen? I will give you a consolidated file consisting of everything, and then that should help your problem. That should solve your problem. Is that okay?
Yes, sir. Will do. Thank you, sir.
Yeah, because what happens, like if I tell you how to do it, you will have really tough time doing it, because there are syntax issues with the programming in Excel, and then you have to go and again put your cursor, delete the space, then put the cursor, delete the upper function, and always there is some issue or the other. So rather than that, okay, but let's take it in bit by bit, and finally once we are done with everything, I will put all at one place and then share with you, and then you can just use that wherever you have one final file you can use for everything, and that will be okay.
Okay, sir. Sure. Thank you,
Okay,
sir.
okay, then we call it a day, and well, let's meet on the next session, and then we do the rest of the things.
Thank you, sir.
Okay.